In the last 24 hours, banks started blocking wire transfers to precious metals dealers. The U.S. Mint quietly canceled silver orders, and then suddenly repriced silver eagles nearly 80% higher overnight. That is not normal volatility. That is a system flashing red, and most people won't realize it until it's too late. Welcome back. I'm John H.G., and this is Silver and Golden Signal Lab. If you've been feeling like the rules changed while you weren't looking, you're not imagining it, because the story isn't just that silver moved. The story is that access to silver is being throttled, prices are being reset, and the paper market is starting to lose control of the physical market in real time. Let me paint the scene fast, because the details matter. Multiple buyers attempted to wire funds to purchase physical gold and silver, not exotic products, not leverage, simple metal. And the banks didn't just delay the wires, they stopped them, they rejected them. They refused to let the money flow to precious metals dealers. When that happens, you need to understand what it really means. That is not a payment glitch. That is a gate, and a gate only appears when someone wants control. Call it what it is, capital friction. Soft capital controls, the kind that begins as compliance and ends as permission. And once it becomes permission, the window closes quietly, without an announcement, without a vote, and without a press conference. Now stack that on top of the next event. People placed silver orders directly through an official government mint website, got confirmation, and then those orders were canceled. In some cases, the charge never posted, which means the system reversed the deal before it even became real. That's the key detail. It wasn't a refund, it was a refusal. And then, as if to confirm the pattern, those same products came back online, but at a completely different price. This is where it gets spicy. Silver Eagles reappeared with a price tag that made experienced buyers do a double take. A product that was recently being offered around the mid-90s range was suddenly listed around the 170 range per ounce equivalent, depending on the exact item and checkout math. That's not a premium. That's a repricing event. Overnight. No warning, no smooth transition, just snap. New reality. So the question isn't, did silver go up? The question is, why would the price be reset that aggressively, and why would access be restricted right before the reset? That is the kind of behavior you see when inventory is tight, demand is spiking, and someone in the chain realizes they cannot fulfill at yesterday's terms. And that leads to the part most people miss. You cannot understand this market if you only stare at the futures chart. Because futures can print a number. Physical needs a product. Futures can be dumped in seconds. Physical has to be sourced, boxed, insured, shipped, delivered. So when the futures price says one thing, but the official mint price says something dramatically different, your job is not to argue with the chart. Your job is to recognize the signal. The signal is the spread. The signal is the premium. The signal is the stress. And right now, the stress is screaming. For weeks, we've seen the same pattern. The paper market sells hard into thin liquidity, price drops or gaps, panic spreads, and then physical demand shows up and buys the dip. Over and over. Slam, absorb. Slam, absorb. The paper moves look violent, but the follow-through looks weak because the physical side is not cooperating. That's the war. Paper wants you emotional. Physical wants you patient. Now, here's where things get even darker. Like when you hear about wires getting blocked, that is not just inconvenient. It's the moment you learn whether your money is actually yours or whether it is a permission slip stored in someone else's system. If you can't move it when you want, where you want, for what you want, then it's not money, it's an allowance. And once the average person realizes that, behavior changes instantly. They stop trusting promises. They start buying insurance. In this context, physical gold and silver become a referendum on confidence. Not confidence in the metal, confidence in the system. And confidence is cracking. Now let's hit the global piece, because this is not just a US story. In Asia, physical premiums have been running hot. People are seeing street-level pricing and local demand that implies numbers way above what the Western paper quote is suggesting. And when that disconnect grows, it creates arbitrage pressure. If metal is cheap on paper in one place, but expensive physically in another place, large players buy where it's cheap, they sell where it's dear, and that action forces convergence. The gap closes. The paper price gets dragged toward the physical reality. This is why the physical market is the judge, not the futures chart. The chart is a headline. The physical is a verdict. Now, people are also hearing rumors about industrial demand, automakers, and supply constraints. Some of it is real, some of it is noise, and some of it is bait designed to get you to trade your emotions. So here's the approach. Don't marry rumors. Marry measurable stress. And the measurable stress right now is visible in 3 places. 1, access issues. Blocked wires and canceled orders. 2, repricing behavior. Overnight adjustments that shock buyers. 3, premium structure. The gap between spot and what you actually pay. The third piece matters more than the memes, because if spot is 90 and you're paying 99, 100 or more for common bars and coins, that premium is a tax on scarcity. It's the market confessing that it cannot source metal at the paper number. And if the premium stays elevated while spot whipsaws, you are watching the paper market fail to do its job. Now, let's address the most dangerous illusion in this entire story. The illusion is thinking the future's number is your price. It isn't. If the pipeline is healthy, delays are short, premiums compress, and access is easy. If the pipeline is stressed, you get longer turn times, minimum order thresholds, rationing behavior, and sudden repricing. And we're seeing all of that. Some dealers have already raised minimums, not because they hate small buyers, but because the volume is overwhelming, the fulfillment pressure is high, and they have to ration operational bandwidth. When demand surges and the backend breaks, minimums rise. That's logistics. Now, let's talk about the most dangerous part of the paper short game. When there are massive numbers of contracts representing metal that isn't sitting there ready to deliver, the market becomes a confidence game. Most of the time, it works because most people settle in cash or trade paper to paper. But when physical demand grows, the game gets dangerous because physical demand doesn't settle in cash. Physical demand settles in ounces. So if net short exposure grows while physical inventories feel tight, the system becomes fragile. Not fragile like it might dip. Fragile like one more shove and it snaps. And when it snaps, it doesn't snap politely, it snaps violently. Now, connect the dots into a single narrative. Banks restricting wires is an early warning of friction and control. Order cancellations at an official mint are an early warning of supply stress. Overnight repricing is an early warning of a reset. And hot physical pricing in other regions is an early warning of global convergence. Put that together and the picture is obvious. The market is trying to reprice silver upward. But the paper mechanism is fighting the move with volatility. The physical side is pushing back with premiums, scarcity, and repricing behavior. This is why the dips are not bearish. There are opportunities for big buyers to accumulate while the headline watchers panic. Now, here's the part that should make you sit up. Most people are waiting for confirmation on a chart, but confirmation in the physical market arrives as out of stock. And when that happens, your chart confirmation becomes irrelevant. Now, before we go further, don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment John A.G. Best so I can see you. Because the next part is where the real cliffhanger lives. If banks are blocking wires now, what happens when fear spreads? If the mint repriced 80% overnight now, what happens when replacement cost jumps again? If premiums are already elevated now, what happens when shelves go empty? Most people think they'll have time. But in this market, time is exactly what vanishes first. Now, let's talk about what comes next, because this is where the story flips from interesting to urgent. In a stressed metals market, the system moves through a predictable chain. Delays, minimums, rationing, repricing, and then restrictions. We have already touched multiple steps in one weekend. That is not a slow burn. That is acceleration. Acceleration creates stories people can feel. Everyone understands what it feels like to be told no by a bank. Everyone understands what it feels like to see a price jump overnight. Everyone understands what it feels like to chase something that used to be easy to buy. That emotional reality is what drives behavior. Now, the paper market will try to counterattack with optics. It will show you drops. It will show you red candles. It will show you talking heads telling you it's over. But you must ask one question every time you see a red candle. Did anything change in the physical pipeline? Did availability improve? Did premiums compress? Did access get easier? If the answer is no, then the red candle is a psychological weapon, not a fundamental signal. Now, the industrial angle matters too, and you don't need conspiracy to understand it. Silver is not just jewelry metal. It's a conductivity metal. It's a component metal that goes into electronics, energy infrastructure, and modern manufacturing. When the world electrifies, silver doesn't disappear. It embeds deeper. And if large buyers start treating silver like a strategic input instead of a commodity they can source casually, they behave differently. They sign long contracts. They secure inventory. They lock supply. And when that happens, less metal floats freely for the public. That's how shortages become real. Not because the earth ran out, but because allocation changed. When fear rises, retail demand rises. When policy tightens, investment demand rises. When manufacturing scales, industrial demand rises. When supply is flat, all three cannot rise together without a price response. Something has to ration the metal. If it's not rationed by availability, it will be rationed by price. And if it's not rationed by price, it will be rationed by access. Availability, price, access. Pick your poison. Now, I want you to picture what happens if the next open is chaotic. If the market gaps up, it validates the physical stress. If it gaps down, it triggers more physical buying. Either way, paper volatility becomes fuel for physical accumulation, because every smash becomes a flashing buy sign for anyone who understands the pipeline. That's why the slams are getting weaker over time, because the dip buyers are not leaving. They're growing. And when dip buyers grow, it takes more paper to push the price down, which increases stress, which increases the chance of a snap. That's the feedback loop. Now, let's ground this in your real decision. You don't need to predict the exact number next week. You need to decide whether you want exposure to a system that is showing you restriction behavior. Because restriction behavior is never bullish for trust. And when trust falls, real assets rise. That's why gold and silver exist. Not because they're cute, because they are the receipts of history. Every currency system eventually asks the public to believe. Gold and silver ask the public to verify. And people are getting tired of believing. Now let's zoom in on the paper mechanics for a second, because this is where the "it's just a chart" crowd gets blindsided. A single silver futures contract represents thousands of ounces. That means a relatively small number of clicks can create the illusion of massive supply hitting the market. It's not a truck backing up to a vault. It's a keyboard. And when enough contracts are thrown at the bid at the same time, the chart drops even if the physical world is screaming for more metal. This is why you can see a paper smash on Friday, and then you wake up Saturday, and the real world prices are higher, the premiums are fatter, and the delivery timelines are longer. It looks insane until you remember paper is liquid, physical is not. And here's the uncomfortable question that sits underneath all of it. How much of this paper can actually be delivered? Because the moment enough buyers demand delivery, the market has to choose between two ugly options: pay up or cash settle. Either way, confidence takes damage. Think about it like this. If an exchange has a mountain of open interest and a much smaller pile of metal available for immediate delivery, the entire structure relies on most participants never asking for the metal. The system survives on rolling. It survives on next month. It survives on "don't worry, it's fine." But when real buyers show up, when industrial users and wealth preservers both want the same ounces, that rollover comfort disappears, and that's when the normal pricing model breaks. This is also why you keep hearing about tighter vault conditions, shrinking registered inventories, and stress around deliverable supply. You don't have to memorize every statistic to understand the direction of the pressure. If deliverable inventory is tight while paper exposure is huge, the only balancing mechanism left is price. Now, if you're sitting there thinking, okay, so what should I actually do? Here's the clean framework. Step 1, stop chasing perfection. You're not trying to buy the absolute bottom. You are trying to exit a system that is showing restriction signals. Step 2, prioritize weight over hype. In a squeeze, ounces matter more than fancy packaging. The market pays for metal, not artwork. Step 3, build a position you can hold without panic. If your position size makes you anxious, it's too big. Calm beats clever. Step 4, watch the premiums like a heartbeat monitor. If spot drops but premiums stay high, the drop is paper noise. And step 5, assume the window closes faster than you think. In every historic scramble for real assets, the public waits for confirmation, and confirmation arrives as sold out. That's the trap. Don't step into it. If you understand that now, you won't be shocked later when the price reopens higher and the banks pretend nothing happened on Monday morning again. Now, if you're buying physical, your mindset matters. If you're buying physical with the plan to panic sell on the first pullback, you're not buying an asset. You're buying stress. Physical is a long game. It's a foundation. It's a hedge. It's a way to keep your purchasing power outside the permission system. So don't buy it like a meme stock. Buy it like a seatbelt. You don't put on a seatbelt because you plan to crash today. You put on a seatbelt because crashes happen fast and warning is always late. That's where we are. Warning is late, the signals are here, blocked wires, canceled orders, overnight repricing, global premiums, paper volatility. This is the market telling you something. So here are my 2 questions for you, and I want you to answer them in the comments. First, if your bank can block a wire to buy metal today, what else can it block tomorrow? Second, if official pricing can jump 80% overnight, what do you think happens when panic hits and people rush the exits at the same time? This is not fear-mongering, this is pattern recognition. And pattern recognition is how you survive an era where the rulebook is being rewritten in real time. So here's the bottom line. The paper price can be pushed. The physical price must be paid. The chart can be manipulated. The inventory cannot be faked forever. And when the physical market finally drags the paper market into reality, It won't be a gentle adjustment. It will be a violent repricing event that leaves late buyers staring at empty shelves and asking, how did this happen? It happened slowly, then it happened all at once. And we are standing in the all-at-once moment right now. Stay sharp. Stay disciplined. Keep your head while the market tries to steal your emotions. Because the people who win this game are not the ones with the fastest fingers. They're the ones with the strongest conviction. Take care of yourselves, take care of each other, and I will see you in the next video soon.